Hello and welcome to the latest Retire Well episode with me, Matthew, and as always I'm joined by Joe. Today we're going to be talking about a really topical area, which is inheritance tax and how people can help transfer assets and wealth down through the generations. Again, this is a really topical area and an area we're having lots of questions about with clients, and that's mainly because of the change to pensions coming into people's estate, and therefore people are thinking, well, what is my estate, what are my assets, and can I be doing anything a bit more proactive about it?
Yeah, I think the pension bit that was obviously sort of introduced in the last budget and expected to come in over the next couple of tax years, we're getting a little bit more clarity on that, but it's still not sort of 100% clear. That's what I suppose triggered a lot of people to speak about it, but I suppose one thing that people also don't think about is rising house prices, which have pretty consistently gone up over the last, 20, 30 years. And the nil rate band and the residency nil rate band, which we'll come on to later, which is essentially the limit that you can have before you start paying any inheritance tax. They've essentially been frozen since 2009, which creates a big fiscal drag where more people are being pulled into sort of the tax band for paying inheritance tax without really seeing sort of a real increase in their real assets.
Yeah, definitely. I think in general, when we think about taxation in the UK, we've had lots of allowances frozen at the same time as assets carrying on, gaining value or people's wealth continuing to grow, and that's sort of squeezed more people into that area of paying tax. And also, from a political point of view, a lot said about the, deficit in the budget and need to squeeze more taxation. So people are rightly looking at their assets, looking at their position and saying, can I be more tax efficient? And ultimately, the message we get from a lot of people is, I've worked hard for this money, or we've worked hard for this money. We've paid a lot of tax to date. If our top objective now is to pass wealth on in a tax efficient way, they feel like that's quite a key objective, and thankfully we have lots of tools we can look at for doing that. And again, in the course of this episode, we'll think about spending money, we'll think about gifting money, we'll think about trusts, we'll think about things like life insurance as well. But ultimately, it's looking at that problem of assets growing and allowances being frozen. And I think you mentioned earlier the number of estates that might be pulled into the inheritance tax situation has gone up quite a bit.
Yeah, currently the amount of estates that actually pay inheritance tax is 27,000 in sort of the last year. I'm expected sort of with this introduction of pensions being pulled into the estate to increase by sort of 10,000 or just over 10,000, which will have sort of many more sort of, I suppose, quote unquote normal working people being pulled in if they have larger pensions. And the Office for Budget Responsibility, they looked at inheritance tax receipts and they're sort of at record highs already. Next year expected to almost hit 9 billion. So and I don't think it's really going away. As you said, the sort of political environment is that we do need to look at more taxation, otherwise they're going to have to look at cutting somewhere to sort of meet that deficit. And the pledge that they made in the election of sort of no taxes on working people really hamstrings them, and that's where sort of inheritance tax and potential bringing pensions in is somewhere where they can look to make up that deficit. But moving on to that and sort of a little bit more into the episode, as always, we'll start with a jargon buster. And when we talk about inheritance tax, inherently we have to start talking about gifting, which is one of the main ways that you can look at getting money out of your estate tax efficiently. And one thing that people will come across quite a lot is the 7-year rule, or a potentially exempt transfer, I suppose, to give it its correct name. Matthew, do you just want to sort of run through what that is and how it works?
Yeah, definitely. I think that area, the potentially exempt transfer, the 7-year clock that people might have seen bits about or heard bits about, for some people it worries them because they think, oh, well, I can't gift something because there might be some taxation due, and it might be due by the person that they're paying it to is what they worry about. Essentially, what happens with any substantial gift that's given to someone, it still sits in your estate for 7 years potentially, and that's the potentially exempt transfer that Joe describes there. Again, if the person given that gift survives for 7 years and a day, that gift has then fallen out of their estate fully, and they don't have to think about it again. And again, when we look at the nil rate band, again, to use some more jargon, and that's the idea that everyone's got 325,000 that can be left with no IHT. Again, your gifts for the 7 years are almost sat in that. So essentially you stack up a bit like a cake and you layer it up. So when we're doing gifting planning with people, we're saying to people, okay, what have you given so far? What are you wanting to gift? Can we do this within your nil rate band? And can we start the process and the ball rolling?
Yeah, I think it's important to make the distinction when you're looking at gifting, with a potentially exempt transfer, and for that 7-year rule to essentially work, it needs to be sort of an individual that it's gifted to.
Yeah.
If you're looking at gifting to a trust, certain types of trust would make it essentially a chargeable lifetime transfer, which is a little bit different. And the difference is you're limited in the amount that you can gift with a chargeable lifetime transfer to the nil rate band, which is 325,000. With a potentially exempt transfer or a pet, it's essentially unlimited. But it obviously will fall into your estate for inheritance tax if you die within those first 7 years. And first 3 years, it's taxed at that full rate of inheritance tax of 40%. After 3 years, it essentially reduces by 8% a year until, as Matthew says, it drops out in sort of 7 years and 1 day.
Yeah, it's sort of tapered down. And again, I think, from talking to normal people who have, got significant wealth and they're looking to gift it, there's always a worry of, I don't want to accidentally start a gifting process and then not live the 7 years, or worry about someone having to find the money to pay some tax. So again, it's really an area that needs a lot more clarity. And again, I think on previous episodes we've talked about gifting out of surplus income. Again, for me, that's something we're going to talk about today, where it's a really key area for people to think about, and possibly the light isn't shone on it enough to give people the ideas of where their gifts can instantly fall out of their estate rather than sitting within the 7 year.
Yeah, as Matthew said, we have covered this already a little bit in past episodes about sort of general gifting and general estate planning. I thought it would be good today to start off by looking at that pension side of things, since it is so topical. And pensions, they're supposed to be used when you're alive to provide you that retirement income, but just by the way that legislation's worked in recent years, they've become a really efficient inheritance tax vehicle, which essentially the rule is at the moment, if you were to have, and this is for defined contribution pensions for the moment, we will touch on defined benefit pensions, but for defined contribution pensions, if let's say you've got £100,000 left in your pension when you're to pass away, if you were to pass away before age 75, that can essentially go to anyone who you class as a beneficiary, completely tax-free, and they can draw it completely tax-free as well. Again, this is current rules. Post 75, they essentially said, okay, you've kind of had your bite of your cherry there, you've enjoyed it for the retirement income, therefore we'll still pass it to the person that you want tax-free, but when they come to draw it, they'll be taxed at their sort of marginal rates, in the same way that you're taxed when you're drawing down from a pension outside of tax-free cash. The changes that are coming in are essentially, before that pre and post 75 rule comes in, they'll add your pension to your estate, calculate whether you're over the nil rate band and tax you accordingly before they pass it on to the beneficiary, and then it's essentially taxed the same way as it is now.
Yeah, and definitely, again, looking at that for married couples, again, there's no inheritance tax between, a spouse. So if everyone's got a nil rate band of 325, and then we've got the potential of the residential nil rate band where you're passing on property to the next generation, for sort of simple maths and thinking about it from a simple point of view, £1 million of allowances available for a couple is the typical bit to look at. And then it's anything above that where people are being taxed at 40%. Again, that does need a property and it does need to be passed down the generations. But from simplicity, it's that element of, will your pension value on death, put you over that figure and cause an issue, or is it going to be a case of actually that's where people can spend and get their assets below, or gift and get their assets below those allowances?
Yeah, and I think it's good there that you've mentioned sort of giving a pension to a spouse, because most people think, right, when I'm setting my death benefits on my pension and choosing who I want, the natural course of action is to choose your spouse or your partner, because they may be semi-dependent on your income and vice versa. But I think it's also not always that well planned sometimes when you're looking from the inheritance tax point of view. If your partner's got enough income that'll be able to sustain them if you were to pass away, and you might have a large defined contribution pension, if you then put your pension into their name when you pass away, with pensions coming into the estate from inheritance tax, you're just creating a problem for them in the future for when they pass away, because it essentially may be taxed at 40% or some of it at 40%. So I think that's something where it's not just a set and forget with death benefits. Yeah. It's on about looking at reviewing it, because it might be the case where if you know that they would be fine if they didn't have this pension, you could look at choosing a beneficiary who is a child or a grandchild, which essentially can pass down that wealth from generation to generation without having to wait for the second spouse to pass away.
Yeah, definitely. I've had a couple of scenarios like that recently, and again, ahead of the rules changing, again, we've had a client who, has passed away, and they've got the choice essentially with the pensions. They've got some significant pension wealth. It could be left to the spouse, it could be left to the children, it could be left to the grandchildren. As part of the assessment and the conversation with the family, the first thing is to say, okay, this gentleman's wife, what income, what capital will she need in her lifetime? As it happens, she's already got quite significant wealth and got quite sort of good guaranteed income sources. So really, she's unlikely to spend or need more capital from the pension. So therefore, as you describe, it's the perfect idea to we then say, okay, they're two children. What capital and income do they need? And actually they're at the point when they're thinking about retirement. So again, that can help them with the process. But they've also got the grandchildren where they've got allowances, and because this individual's passed away after 75, it could be a case of moving some of the allocation of the pension to the children. They could essentially be then cashing it in over the next few years, not paying any tax because they've got the allowances available, and then they would have a pot of money in their name, tax-free, going forward, for future, investments, growth, capital, even thinking about putting into pensions themselves. So that's the perfect example where it's not necessarily, the obvious route, but it's the very tax efficient route. And once we've talked it through and identified it with a client, actually it can be really a clever way of doing it. And one other similar example to that I've had recently was someone who was in beneficiary drawdown. So their husband had passed away before 75, and they had a large pension that up until the proposed changes of the rules, they were going to either spend or then pass on to their own daughter. Because they're already past 75, if anything happens to them, they'll be leaving that pension as taxable income to the next generation, whereas currently they can draw it tax-free. So we've gone through the planning route there where we say, actually, we can use that capital now, you can pay that out to you with no tax, and you can then start a process of gifting that and planning where it's then we're talking about the 7-year clock, we're talking about life insurance, we're talking about trusts, and we're planning how we can best then move it down the generations, to her daughter, but also looking at the grandchildren as well.
Yeah, and just on that, finally, sort of on passing it down, another step, I suppose, which you can look at there, particularly if there's an age gap between spouses, is if the younger one was to die early and pass it on to someone who might be over the age of 75, they obviously would inherit it tax-free, but as soon as they were to pass away, if they don't need it, they would pay tax. So that's definitely somewhere where I think you should look at advice on that, and it's not something to make a split decision. But absolutely, definitely something to review and look at going forward. So just picking up on what you said earlier with regards to potentially look at gifting some of the excess income that you have from pensions, I thought it'd be interesting to look at the numbers. I mean, at the moment, it doesn't necessarily make a great deal of sense, given that you can inherit it completely tax-free. Maybe there's an argument to look at it after 75, because then you're potentially paying taxable income. But now, when you look at it, if you are paying that 40% of inheritance tax and potentially looking at paying the income tax as well, you could actually get sort of a massive saving on it in terms of if you have a higher rate taxpayer potentially and an inheritance tax liability, the actual marginal rate of tax could be almost 67% essentially, which is a good saving. But then if you flip that round and look at sort of, okay, we're gifting retirement income and we're gifting out of a pension, you might have the issue of not having any tax-free cash left, and you might only be taking out of sort of potentially taxable income. So then that's almost the conversation of, is it worth paying 20% now to take it out of the pension to say 40% or maybe 67% in the future? What are your sort of general thoughts on that?
I think it's a common question that we're having now, and the idea that people don't want to pay tax twice. it's not it's a bit of an art, not a science, in the sense of we don't know what a future change could look like in relation to tax rates. We don't know what growth will be like, so we can't say exactly to someone, yes, you're going to be better off doing it this way. But certainly on the taxation point of view, if someone can, pay 20% income tax and then give something and it falls out of their estate and there's no inheritance tax to pay, and they were likely to pay inheritance tax of 40%, yes, there's a tax saving. And you've also got the idea that you've then gifted it earlier, so you've maybe let your family benefit from it, and you've brought that forward. So there was like we've talked about earlier, there was the idea that the pension could have been the estate planning tool for the family, and again passed on death, and that could almost be the no one's getting any extra gifts in their lifetime. It's just purely the pensions going down the generations. This idea of paying some tax to give some money now definitely brings that forward, and people quite like the idea. The bit that I mentioned earlier about that sort of gifts out of surplus income, again, if you can look at your own situation and your income coming in from pensions, any rental income, any interest, that sort of thing, if that is higher than your day-to-day expenditure and you can demonstrate that from your records, you can gift 100% of that surplus, and it doesn't count for the part of the 7 years. So again, that could be a really powerful way of doing it. But when someone's looking at creating that additional surplus, they could take more taxable income, but what are they thinking about? It's the same thing that everyone wants to think about, of not going up into the next tax bracket or not hitting a trigger for additional tax.
Yeah, I mean, on that gifting as well, your gift to a beneficiary might be a child or grandchild. That might, down the line, allow them to make further pension contributions, which means they may indirectly be able to get some of the tax back. But I suppose we've maybe jumped ahead a little bit on that by looking at people that have surplus income. That the vast majority of people do use their pensions and current assets for retirement income. That is what they're for. So then it comes to, how do we sort of change how we might have looked at structuring retirement income once these changes do come into effect? So I suppose status quo at the moment, because pensions are so efficient from an inheritance tax circle, we look at drawing on ISAs and cash and other investments before the pension, because pension can be inherited tax-free at the moment, pre-75. Now I think more people are looking at how can we maybe change that to reduce that value of the pension, that, again, it might allow you to gift in the future, or you might just be using it more for your day-to-day and reducing it down first.
Yeah, I think it's that first element of almost trying to say, what is the objective? If that pension is a tool to be spent and that's going to be used in your lifetime, then you don't need to think about it as part of inheritance tax. If you think that you'll use some of it, but some of it you don't think you'll touch, or if you actually get good investment growth and therefore it gets bigger and bigger and you start to say, okay, this, I've got other income sources, I'm not likely to spend it, that's when the priority can shift, and we are seeing people go, okay, I might, like we described earlier, I might take some more income, I might pay some tax on it to then gift it to the next generation. Like you said, does our first generation want to have the growth building up in their name, or do they want to have paid some tax now to then let the growth build up in the next generation's name, perhaps?
Yeah, absolutely. And we're talking about pensions, and we're talking about pensions a lot of the time once you've actually already passed away. So we do probably need to touch quickly on death benefits within a pension, because what we've spoke about is assuming that you're able to access something like beneficiary drawdown, which is a more modern style of drawing from your pension when you pass away. Matthew, do you just want to spend a little bit of time on sort of the different types of death benefits that you have, particularly maybe on legacy pensions?
Yeah, definitely. So on paper, if someone passes away with a modern pension, they should be able to take beneficiary drawdown to essentially carry on flexibly taking that pension like the original member did. They could buy essentially a beneficiary annuity, so they could be getting a guaranteed income there, or they could be taking the whole pot as a lump sum. The bit that people have to be concerned about and look at is just to make sure that their pension has those full options, because without the contract you're in having those options, you might think, oh well, we can do this, I've heard it on the podcast, but actually your pension might not allow it. So We were looking at a legacy pension for a client recently, quite an old pension, set up in the 80s, and that pension's only death benefit was it has to be paid out 100% as a lump sum. You couldn't purchase an annuity, you couldn't go with drawdown. So in that situation, the next generation who's inheriting that pension hasn't got a choice. They're essentially going, that's dropping into your bank account, and because this person's passed away after 75, that's going to be taxable income. The pension pot we were looking at, was broadly 100,000 split between two beneficiaries, so £50,000 worth of taxable income dropping into someone's name. Again, both of those individuals are already working, so they're already using some of their allowances. Some of them might be getting close to 40% tax anyway. So from a tax efficiency point of view, that death benefit was very poorly structured. Again, nothing we can do now, but for people going forward, there's an encouragement to say, actually review it, look at it, and that's a really important point where, that family we were talking about, they'd previously done everything themselves. It was all very DIY. There's a point where advice would have added value straight away to just move that, structure it, and save some tax.
Yeah, and death benefits as well obviously differ whether you're in a DC, a flexible pension, and a DB, a more sort of structured pension that you have. Again, you might have more limited options with a defined benefit pension. You may just have a spousal pension that has to go to a spouse. Sometimes it could include sort of a dependents pension, or maybe an adult's dependents pension. I think it's just something to be aware of. There's obviously less inheritance tax planning that you might be able to do with that as opposed to a flexible pension.
Yeah, and I think that's a key topic. Again, anyone who's looked at our ideas and videos about defined benefit pensions, again, they'll look at the option of transferring it and how that adjusts the death benefits. Again, we don't need to sort of touch upon it today, but there's those elements of when someone's accepting that pension, it's just knowing the full implications of what they're accepting. Again, in the same way that a defined contribution pension can be moved and changed, once someone's pressed the button for that defined benefit pension, that's it. So they need to be really confident, then understand all the options when they're pressing that button.
Yeah, absolutely. I feel like I now need to sort of be sort of the angel on the shoulder as opposed to a devil here. We've been pretty negative on pensions this episode, when usually we talk about all the great things you can do, and they are still really powerful. It's not saying because this legislation might be coming in April 2027, don't save into a pension and take everything out of your pension. That's not the case. It's more just being mindful of it and thinking about what are our goals and objectives, what are we wanting to achieve with our pension during our lifetime, and if we can do it all, how can we be a little bit more tax efficient for the next generation?
Definitely. I think, if anything, the reason why the pension rules changed in relation to them falling into someone's estate for inheritance tax was because the pension had probably become a little bit too powerful and a little bit too generous. So there was an element that people could put significant amount of money in, get tax relief, get tax-free growth, and then if they weren't going to spend it, they could pass it on outside their estate and no inheritance tax. So what's still there in relation to a pension? You still benefit from tax relief on the way in, so that's incredibly powerful, especially from a higher earner. There's no CGT, or there's no tax on growth within the pension. So once your money's in and working for you, that helps build it up, and then it gives people that ability to be flexible in retirement and potentially to retire early or meet some objectives. So yeah, we're still definitely banging that drum of pensions being really valuable, but as you rightly just point out, it's more the conversation of how we access it and when we access it, that for someone who said, I don't need any income from my pension, it was okay, well, you just leave it there and it can be passed on. Now it's okay, can it become a slightly different vehicle of how do we create surplus income, or how do we sort of cascade wealth down the generations? Yeah,
and equally, we can only operate on the legislation of the day. It was only 10 years ago that you could actually first access pensions flexibly, and even 5 years ago, less than, we had the lifetime allowance. So what's in place now might not necessarily be in place when you pass away, I suppose, is a way to look at it. You just sort of work on it and look, as I said, be mindful and look at sort of how we might want to sort of change it going forward.
Yeah, I think in the same way that we can't predict interest rates, we can't predict inflation, again, regulation, tax changes. So having an element of flexibility to a plan is perfect, but you still want to have thought about the current rules and thought about your process. So You can have a joined up thought process, and very much, one of the things that we've been encouraging our clients to talk to the next generation, think about the joined up plan, because you don't want mum and dad or granny and granddad to have a really good plan, and actually then when it's implemented, the next generation to say, oh, actually, no, we wanted you to spend it, we wanted you to enjoy it, we want to have people sat down at the table almost, so there's a joined up thought process. Yesterday I had a meeting with 3 generations. Again, it was good because the grandson's interested in investments, interested in pensions, and you've got the sort of different family members contributing to the conversation. So I think that can help. Everyone's on the same page. Everyone knows what the plan looks like, and going forward, it's not going to be a surprise.
Yeah, I think it can be quite a taboo subject. I mean, often people don't like to talk about the finances, but I think it is really important, particularly when you're looking at something that will affect the next generation. I think quite a lot of the time we will look at sort of the most tax efficient thing that fits in line with the client's goals and objectives, and those goals and objectives are a really important part, because if it's not a priority for estate planning, we won't say, oh, look at taking money out of your pension and give it away. But some people, it really is a priority, and they get a lot of value out of that, knowing that the next generation is provided for. But if you don't speak to the next generation and let them know that that's what you're wanting to do, then you could come into potential roadblocks where they say, oh, I don't want you to give me this now. That's something that you've got to rely on for your retirement because it's coming from your pension, when in reality your pension might be excess and surplus to your needs. So I think it really just is important to sort of speak about that as and where is possible. Not always. You can't always do it. You can't always sort of. You might want them to inherit. I've had situations where people have wanted people to inherit, but not them know about it until they've already passed away, which does make it a little bit harder. But yeah, I think where possible, sort of speak about it with the next generation and let them know what sort of the plan is, so they can continue it when you're no longer around.
I've had a couple where they've sold a business, had good wealth, and it's been a priority to pass that to the next generation. But the next generation were career driven and had done particularly well themselves. So actually there was an idea that the parents were going, well, we don't want to spend this, we want to pass it on. But the next generation was almost saying, well, we've actually got more than enough, and we're hitting these tax buffers and we're hitting these allowances issues. So actually that was the idea of, going back up to mum and dad to say, maybe it is your priority, but equally, if you have anything you want to do in your lifetime, if there's anything else that you want to spend, don't feel like you haven't got that funds available because you've already ring-fenced it in your head. Spend it first, then think about gifting, then think about estate planning, to try and get the best use of the money, so to speak.
Yeah, in that scenario, that's why I'd sometimes like to frame it, because it's easy talking about spending money and reducing the value of estate. Sometimes it's a lot harder to spend it, particularly if it's been ingrained through your life that you've worked hard for your money and you're a saver. I like almost framing it in, if you do have an inheritance tax liability, every pound that you spend, you're getting a 40% discount on it. So if you're getting a £10,000 holiday you've always wanted, it actually costs you £6,000, because if you didn't spend it, it was going to the taxman anyway.
I might have to try that one, definitely. But no, I think it's a very valid point, and I think it's just trying to find the sweet spot and trying to find a balance. Ultimately, if people have a significant amount of money in a pension and then we get compound interest, we get good investment growth, that can be where the values do escalate from, and that can be, as you describe, it can be hard to spend that money at that point. So again, it's I had a guy, and there's a few people in comments and some of our videos before who say, you want to die with £0 in your bank account. Again, that's impossible because you don't really know when you're going to pass away. But there's the element that, do you want to have £1, £100, 100,000, a million? There's an element of trying to be, we're quite conservative with that sort of planning, so we try and have a buffer available. But equally, it could be, if you haven't got a plan with the pot, the idea of having £1 million in your pension when you pass away, if you haven't thought about what that's going to happen with that money, it could almost be a missed opportunity.
Yeah, I mean, I've mentioned it on the podcast. I quite enjoy that sort of philosophy of getting everything out of the money that you've had, and a common kickback on it is, oh, well, what about the children? I want to pass money on to them, sort of as and when. But if that really is truly your goals and objective, why are you leaving the amount that you want to leave them to chance? Because it could sort of run out. It could be much more than you're actually wanting to gift. So that's where it becomes sort of, be purposeful about your gifting, make sure that it's part of your plan, and then you can control how much you give them instead of being hit by a bus and they inherit your full estate in early doors.
And some people flip it the other way and they say, oh, well, people are going to get property, people are going to get this. Again, we think it's really interesting when someone says, oh, well, my top objective is to leave some money to the next generation. And then we think, okay, well, life insurance can do that. And again, there's certainty with premiums, with a whole of life policy. Again, premiums can be more expensive as people get older, but there is a certainty to it. And it doesn't have to be leaving assets. It could be leaving things in trust and things like life insurance.
Yeah, we spoke sort of in a relatively recent episode 22, I think it was, about more sort of comprehensive estate planning, looking at using gifting, looking at the use of trusts and the different type of trusts. So it'd probably be useful for some people that are looking at that to look back at that episode and maybe get a few more ideas there. I wanted more to sort of focus this on pensions and sort of how we'd work at there. But saying that, we'll jump onto a listener's question, which is actually maybe not in relation to pensions, but we'll run through it anyway. This is sort of a potential client and his wife that are in their late 60s. They had sort of quite a large estate worth around 1.2 million, so potentially sort of subject to inheritance tax. Issue there is sort of most of it's tied up in the family home. Potentially some of it was within pensions as well, and they wanted to pass as much as possible onto the two children as they can. Don't need that much income really. What are sort of some practical steps that you could maybe look at to reduce the IHT liability there, Matthew?
Yeah, I think it's an interesting one, and I think when there is a lot of the wealth tied up in the property, it does reduce the flexibility to sort of say, okay, what are you going to gift? What can you reduce? Because again, if you had that same scenario and the house was worth 200,000, then you would say there's a lot of flexibility to gift assets, put money into trust, or spend some assets. So really, the starting point I would have with that sort of individual or that sort of couple would be to say, do you have any plans to downsize? Do you want to be in the property forever? Again, a more sort of nuance, I suppose, now is some people are thinking about mortgages throughout retirement. Again, in that scenario, if you took on a later life mortgage, you could then be looking to gift that money, potentially pay that back over time or interest only using pensions and other sources. And obviously a mortgage is a debt on your estate, so you are actually bringing your estate down potentially for inheritance tax by doing so. But really it's trying to work out what is spare or what is something that you can't give away. And I think property is one of those assets that people might say, is there a magic way to put it in trust or gift it? And the answers are always no. Again, there's caveats with gifting and with trusts that you'd have to pay a market rent if you were truly gifting it. So it's trying to work through those quirks, I suppose.
Yeah, I think with that as well, that's really important to speak to sort of the next generation, those two children, because as you said, it's hard to sort of liquidate a property, but you do have the option, as you said, of looking at something like a mortgage or equity release plan. Yeah. And I think they're seen in a bad light by quite a lot of people in the UK generally, from people might have been missold them in the past. It's now sort of a much more, and potentially getting into sort of negative equity on the house, and it's now a much more regulated space where if it's part of your plan and you're wanting to gift, it's something you can look at. That is definitely something where I'd say look at speaking to your beneficiaries, look at speaking to an advisor and make sure that you're going down the right route with it. Because if you I don't know, one of the children was absolutely dead set on inheriting the family home and then realised there was a big mortgage on it that they didn't know, then that's going to cause some ructions maybe.
Definitely. I think, when I did the equity release exam, I remember sort of thinking lots of these products, you wouldn't touch that, you wouldn't touch that. But there's a few modern products that do solve those issues. And again, I've talked to a few people in this scenario where you suggest it, and someone does go, I've spent my whole life trying to pay down my mortgage. Why is it now sensible to take out a mortgage against that property? And again, it's a bit of a quirk on the inheritance tax planning and having a debt to the estate when someone passes away. Yeah. But certainly it's an option. And it also is very powerful if you say, I want to draw down on that asset perhaps, but I don't want to sell the asset, then you have limited options to release the funds if you don't look down the mortgage or equity release route.
Yeah, just finally on equity release before we sort of wrap up, I think it's the case of you need to have the rest of the plan in place before you do it, because if you take out an equity release product on a mortgage and you're getting charged an interest on what was your home, and then you leave £200,000 just sat in your bank account, that's not achieved anything. The act of doing it doesn't achieve anything. It's the act of then potentially look at gifting or spending, which, to be honest, is probably the harder part of the actual plan.
Yeah, true. I agree on that one.
Fantastic. Do you have anything else you want to cover, or should we wrap up?
No, I think that's covered a lot of ground, and as always, we'd like any comments to be made, any questions people have got. We'd like to pick them up for future episodes. One quick bit from Wealth of Advice: we're currently raising funds for a local charity, so we're going to post a little bit in the bio about that. We're doing a walking challenge, and everyone in the office is currently walking and running to build up those steps to raise some money for a local hospice that we think does a fantastic job in the community.
Yeah, absolutely. So thank you very much for sort of listening this week. We'll obviously be back again next week for another episode. Like and subscribe and put those comments in as you always do, and we look forward to seeing you again next week.